For 90 days, I ran 5 different trading strategies on a live account with real money. Same market conditions. Same starting capital, same rules applied to each one. No cherry picking, no curve fitting, no hiding the bad weeks. Every trade logged, every result documented. What I found surprised me, not because one strategy dominated, but because of why 4 of them failed. And the reason has nothing to do with the strategies themselves. By the end of this video, you will know exactly which strategy survived, what killed the other 4, and the one insight that changed how I think about trading forever. Before the results, the structure of the test: 5 strategies, each allocated an equal share of the starting capital. Each traded for the full 90 days with no adjustments, no optimization, and no early exits. The same risk management rules applied to all 5. 1% maximum risk per trade, a written entry and exit plan for each setup, and a trading journal entry within 24 hours of every trade. The only thing that changed between strategies was the signal, what triggered the entry. Everything else was identical. This is the only way a comparison like this produces meaningful data. Change one variable, keep everything else constant. Strategy 1. The moving average crossover. The 50-period moving average crossing above or below the 200-period moving average as the entry signal. This is one of the most widely taught trading strategies in existence. It is simple, widely understood, and has decades of historical documentation. Over 90 days on a major currency pair, this strategy produced 34 trades, win rate 41%. Average winner, 1.8 times the risk. Average loser, the full 1% risk. Net result after 90 days, plus 6.2% return on the allocated capital. It worked. Not spectacularly, but it worked consistently, with minimal emotional strain and with a clear rule-based entry that removed almost all subjectivity. Strategy 2. RSI reversal trading, entering long when the RSI dropped below 30, oversold, and short when it pushed above 70, overbought. This strategy produced the highest number of trades, 61 over 90 days, and the highest win rate, 58%. On the surface, those numbers look excellent, but the average winner was only 0.7 times the risk. The average loser was the full 1%. A strategy with a 58% win rate but a reward-to-risk ratio below 1 is a losing strategy over large sample sizes. The math overrides the win rate. Net result after 90 days, minus 4.1%. High win rate, losing money. This is exactly the trap that destroys traders who measure success by how often they are right. Strategy 3. Breakout trading. Entering a position when price breaks above a recent resistance level or below a recent support level with increased volume. This strategy produced 28 trades over 90 days. Win rate 36%. Average winner 2.6 times the risk. Average loser the full 1%. Net result plus 11.4%. The highest return of all 5 strategies. But here's the part the raw numbers do not show. Breakout trading produced the most emotionally difficult trading experience of the test. The losing streaks were longer, 7 consecutive losses in one 3-week period. Watching 64% of your trades close as losses, even when you intellectually understand the math makes it profitable, is psychologically brutal. The strategy worked, but it only works if you can survive the losing streaks without abandoning it. Strategy 4, news trading, entering positions immediately after major economic data releases, non-farm payroll, inflation reports, central bank decisions. The theory is sound. Large data surprises create directional momentum. The practice was a disaster. 19 trades over 90 days. Win rate 47%. But spreads widened dramatically during news events, sometimes 5 to 10 times the normal spread. The actual execution cost per trade was 3 to 4 times higher than expected. Average winner 0.9 times the risk after execution costs. Average loser 1.4 times the risk after slippage. Net result minus 9.8%. The strategy failed not because the analysis was wrong, but because the market mechanics during news events made consistent execution essentially impossible for a retail trader. Strategy 5. Pure price action trading. No indicators, no news, only support and resistance levels, candlestick patterns at key levels, and volume confirmation. This is the most subjective strategy of the 5, and that subjectivity was both its biggest strength and its biggest risk. 23 trades over 90 days. Win rate 52%. Average winner 2.1 times the risk. Average loser, the full 1%, net result, plus 8.7%, but the subjectivity created a problem not visible in the numbers. In the first month, the quality of setups taken was inconsistent, some valid, some emotional, some borderline. Only by month 2, when the journaling revealed the pattern, did the setup quality tighten. The last 30 days of the strategy produced significantly better results than the first 30. Price action works, but it requires self-awareness the other strategies do not. Here are all 5 results side by side. Moving average crossover, plus 6.2%, RSI reversal, minus 4.1%, breakout trading, plus 11.4%, news trading, minus 9.8%, price action, plus 8.7%. 3 strategies profitable, 2 strategies losing, combined portfolio return across all 5, plus 12.4% over 90 days, because the profitable strategies outweighed the losing ones in net terms. But here's the insight hidden inside these numbers. The two losing strategies did not fail because the underlying logic was wrong. They failed because of execution cost and risk-reward math. And both of those problems were visible before the first trade was ever placed, in the rules of the strategy itself. The strategies did not fail the traders. The traders who used those strategies without checking the fundamentals failed themselves. The most important finding of this entire 90-day test has nothing to do with which strategy won. It is this: every strategy in this test was profitable in the right conditions, and every strategy was capable of losing in the wrong ones. What determined the outcome in each case was not the strategy. It was the combination of risk-reward math, execution costs, and psychological sustainability. A strategy with a positive expectancy, traded consistently with correct position sizing, in conditions where execution costs do not destroy the edge, will be profitable. That is the formula, not the indicator, not the signal. The formula. Before trading any strategy, including the 3 that worked in this test, run 4 checks. First, calculate the expected value, multiply the win rate by the average winner, and subtract the loss rate multiplied by the average loser. If the result is positive and the strategy has edge, if it is negative or 0, do not trade it. Second, calculate the real execution cost per trade, including spread, commission, and typical slippage. If execution cost eats more than 20% of the expected winner, the edge may not survive live conditions. Third, test your psychological tolerance. Can you survive the maximum expected losing streak of this strategy without abandoning it? If not, the strategy is wrong for you regardless of its edge. Fourth, paper trade for 30 days minimum before live capital, not to prove the strategy works, to prove you can follow the rules under realistic conditions. If I had to pick one strategy from this test to trade going forward, it would not be the highest returning one. Breakout trading produced the best numbers at plus 11.4%, but the psychological strain of 7 loss streaks makes it unsuitable for most traders, especially early in their development. The strategy I would choose is price action trading, plus 8.7%, because it rewarded the consistent application of journaling and self-review with measurably improving results over time. The strategy that improves as you improve is more valuable than the strategy that produces the best numbers when run by a machine. Trading is not done by machines, it is done by people. The best strategy for a human is the one the human can actually execute, consistently, correctly, and without psychological breakdown, across hundreds of trades and multiple years. 90 days, 5 strategies, 1 real finding. The market does not care which indicator you use. It rewards traders who understand expectancy, manage execution costs, trade with correct risk management, and have the psychological resilience to follow their rules when the losing streaks come. No strategy in this test failed because the market was unfair. 2 strategies failed because the math was never checked. The other 3 worked, not perfectly, not without pain, but consistently, provably over time. That is all trading is. Consistent application of a positive expectancy system, nothing more, nothing less. Share this with a trader who is still searching for the perfect strategy. The next video is right there.